Welcome to today's lecture. After having talked a lot about the German banking sector and the peculiarities of our banking sector, we will now turn our attention to something that is much more general and much more theoretical in nature. We will try to analyze the question, why do banks exist in the first place? Because we have seen that banks perform several tasks that are quite close to the ones also offered by financial markets and more general by financial intermediaries. And the question is why we do need financial intermediation in the first place. Because, as I've said in several examples, if you go to a bank, you're in need of financing. You want to finance an investment project, and you could achieve the same goal also by looking for investors yourself. And there seems to be something that banks are doing better, more efficiently, or at lower cost than, for example, other financing agents or other industrial companies are doing. So there needs to be a reason, several reasons why banks do something better. Let me just close it. Why they're doing something better than other agents in the economy. And this is the very heart of financial intermediation. I've already told you that financial intermediation is also a master's course offered by Professor Vollmer in the economics degree. And financial intermediation is very theoretical because this is the part in financial economics where economists look at the existence and the way banks do their business. And will present and discuss the very basic results from financial intermediation here as well, because this is something that should be included in any lecture on banking. So we start with a basic idea of what financial contracts are in this field, and then we'll talk about the basic explanations for the existence of banks and financial intermediation in general. Now, usually, when we start in economics, we usually assume that we have a perfect and complete market, which usually means that all agents have the same set of information. They possess all information. They are incredibly fast in processing these information, and you have no transaction costs and everything's perfect. And in such a market, there's no reason why a bank should exist, because if you do not have any costs for transactions, if you do not have any need, if your economic agents do not have an advantage over other agents when it comes to information, why do we need banks? Why should we need banks? Because we could try to finance our investment projects all by ourselves. So we need something more than just a perfect market. In modern microeconomic banking and bank theory, we usually assume that markets are not perfect, and the first thing we need to do is we have to assume that information is not symmetrically distributed. So we have asymmetric information, and what does asymmetric information mean? Any idea? Someone has more information than someone else. And in this case, who has more information than someone else? Which party? Which economic agent? If you look at the usual contractual relationship between a bank and a customer.
Well, the one who is trying to borrow money, so the customer.
The customer has more information. Why?
About if he's willing to pay back his debt.
Yes, exactly. The customer has more information on his own willingness and ability to repay the loan. If I go to a bank and I ask the bank for a loan, I know what my capabilities are. I know what my income is. I know what my personal wealth is. And I know whether I'm maybe even aiming and trying to defraud the bank. The bank has to rely on the information I, as a customer, am providing the bank, and perhaps some publicly available data. If it comes to a company, perhaps a balance sheet or income statement data. But the bank is required and needs to get more information on you as a customer. And then afterwards, the bank has to decide whether to grant you a loan or not. So there's a fundamental difference in the information set between the bank and the customer, and we have asymmetric information. So asymmetric information is a situation in which one acting party possesses more information than the other party, usually in a contract. And in this case, it's a loan contract. And of course, if one party has more information than the other party in the contract, this party will usually use this advantage for its own good. So I, as a customer, will exploit the situation that the bank does not know what risk I'm actually posing. For example, if I'm a company and if I'm already close to bankruptcy, I might still go to a bank and try to get a loan, and I will be in a starting situation. I would not provide the bank with the information that I'm close to bankruptcy. I would tell the bank, yes, of course, I have enough money, I'm able to repay the loan. Then the bank will give me its money, and I will later on say, oh, I'm so sorry, I cannot repay the loan. So I will use this to my own advantage. And financial contracts and asymmetric information in this setting, of course, plays a pivotal role for explaining the very existence of banks, because it seems that banks can achieve something in this relation between an investor and the company or person financing the project, and the financial intermediary in the bank is able to make the situation a little bit better. And we will see how this works. So this is our starting situation, and we'll look at two basic models to explain the existence of financial intermediary. We already call it FI for financial intermediary. So this is usually a bank, but it could also be someone else who is making a financial contract possible, or offering a financial contract. Now, the first model is a setting where the existence of the financial intermediary is exogenous. So this means that we simply accept the fact that there is a financial intermediary. It's exogenous, and it is not a result of the model itself. And we look at the way the bank and the financial intermediary does its business. In the second type of model, the very existence of the financial intermediary is endogenous. So it's a result of the model setting. And of course, the latter situation is more interesting. If we simply say, okay, we have a model and we assume that financial intermediaries exist, and this is a given, this model does not tell us anything about the question we are actually trying to answer, the question why financial intermediaries exist. But the second type of model is the one where we have a setting in the economy, and for some reason, because some factors are interacting with each other, financial intermediaries suddenly automatically pop up as a result of the model setting. So this is an endogenous setting. So first, we'll have to talk about financial contracts and cooperation. Now, we assume for this type of financial contract that the things that we agree on in the contract and the cash flows do not have to happen at the same time. This is what usually happens in a banking contract. We grant a loan as a bank, we pay out the loan sum, and afterwards, at a later time, we get the interest payment and we get the repayments on the loan. So this is the first one. The second distinctive feature of a financial contract is, of course, that usually cash flows are not safe. And they are probabilistic, so we do not exactly know how much money is going to be repaid by the other party. If we have a safe assumption, symmetric information, and a perfect financial market, we could simply calculate the value of the financial contract by taking the internal rate of return of this contract. In that case, we know that the risk-free rate is the best interest rate to use for calculating the net present value of your cash flow, and this would simply be the valuation of this cash flow. If, of course, the repayment is not safe and the repayment is risky, we need to know the risk function, and we need to know whether the investor and the financing part, whether they are risk friendly, whether they are risk neutral or risk averse. So we need the utility and risk utility function of the investor. If we also assume that information is distributed asymmetrically, the situation becomes much more complex, because then we have risky repayments, we have a risk-averse or risk-neutral investor, and we also have investors who have different sets of information on the whole economy. What could happen when we have asymmetric information is the first situation is the one of moral hazard. Does anyone know what moral hazard is and what kind of situation moral hazard describes? Yes?
Not sure, but like a situation when you can make something bad or good.
Maybe you can give me an example. It's closely related to adverse selection.
If you get, if you're in a court and you get the opportunity to, if you pay people depending on in the court on how many people go to jail, for example.
Yes.
They will do anything possible to take people to jail because they need to go to jail, but because you get paid for that. So
yes.
You're not doing the right thing. Just.
Not exactly. Moral hazard and adverse selection are two situations that arise when you enter a contract. Adverse selection is a problem that arises before the contract is signed, and moral hazard is a problem that can arise after a contract has been signed by all parties. And both are a result of asymmetric information. Someone knows more than the other party. And moral hazard is the situation in which you have entered a contract, you or your contract partner knows more about you or the other party, and he or she uses this information for its own advantage. And one example, for example, is if you enter an insurance contract, say health insurance. You know, for example, that you are an avid snowboarder, and you do not tell your insurance company that you do have snowboarding as a hobby when you sign the contract. And after the health insurance contract has been signed, the accident insurance, you later go snowboarding, have an accident, and you cause a loss to your insurance. This is moral hazard. You change your behavior or you have more information after a contract has been signed. And if you change your behavior, usually your contract partner has less information and cannot control your behavior. Same thing with, for example, smoking. You don't tell your health insurance that you are a smoker, and then afterwards you smoke. And the insurance company calculates a premium based on the fact that you are a non-smoker, and then later on you start to smoke, but the insurance company, of course, cannot control the fact that you are a smoker. So this is moral hazard. It's a situation in which in a transaction or in a contract, one party has more information than the other party on the behavior of one contract partner and one contract side after the contract has been signed. Adverse selection is a similar problem that arises before the contract has been signed. And adverse selection usually causes the wrong partners and the wrong parties to enter a contract. Also an example from insurance. In insurance, if, for example, I would say, okay, I have a health insurance for people with, I have health insurance for smokers and non-smokers, I would perhaps calculate a premium of 100 and 200 euros per month. And I cannot distinguish between smokers and non-smokers. Maybe I'm not allowed to ask whether you're a smoker or a non-smoker. And one thing I could do is I would simply offer a mixed premium of 150 euros. And then in that case, you are a smoker, you are happy because usually you would have to pay 200 euros. You are now getting health insurance for 150 per month. You're a non-smoker, you have to pay too much. But you know that you are a non-smoker, you know that you are a smoker, so if I tell you 150 euros, you will be happy and you will tell me, no, I'm looking for another company to offer me health insurance. And I will stick with all the smokers. This is adverse selection. I'm selecting the set of bad risks. And it's an adverse selection for me as one party in this contract. And this happens before the contract is even signed. So it's close to moral hazard, but the distinctive feature is that adverse selection happens before signing a contract and moral hazard happens after the contract has been signed. And this is due to either hidden action, I cannot, or hidden information first, I cannot observe a certain information on my contract partner, or something that happens and something the contract party does afterwards. This is hidden action. For example, I suddenly start to smoke. I suddenly start to snowboard. Okay. In insurance, there's a further distinction. Moral hazard in a much more narrow sense. This means that I'm not doing the best I could do to prevent something from happening. So I'm not actually not snowboarding, but especially in fire insurance, I'm not taking any precautions or all necessary precautions to prevent a fire. I'm not doing the best I can to reduce the probability of a loss. And this is also moral hazard in a very narrow sense in insurance, because I'm not behaving in the best way my contract partner would like me to do. Okay. What could I do to solve these problems, both adverse selection, especially moral hazard? Usually the contract party that has less information or less ability to control my behavior of the other party, it can do something, but this will usually involve some costs. For example, the insurance company can try to observe the smoking and sports behavior and activities of my contract partners, of my insurance customers. But of course, this will include some cost. I will need to, for example, hire people to check with my customers whether they've installed a fire installation, whether they have installed maybe a camera. So this will be related and this will connect it with costs. And the difference between the optimal solution in case we have symmetric information and the best situation under asymmetric information, these are called the first best and the second best solution. Because the best solution would be if we have symmetric information. The insurance company simply knows the risk of the customer. The bank knows the risk of the customer. This is the first best solution. The second best solution is what can be achieved in an optimal setting under asymmetric information if we have to accept the fact that I, as a bank, cannot know all the facts about my customers. But I could simply incur additional costs and I could try to make the best out of this situation. This is the second best solution. Now, let's move to some possibilities to explain the existence of financial intermediaries. Two possible approaches to explaining the existence of banks would include that banks, for some reason, are able to lower transaction costs. So in this case, they would be quite similar to other intermediaries in industrial sectors, like, for example, retail companies. For some reason, they are able to offer services that are lowering transaction costs, or they allow to find the best, at least the second best solution when it comes to financial contracts under a situation in which we have asymmetric information. And in fact, it's the second one. It's not so much about transaction costs. One could think of a simple solution that banks and financial intermediaries are simply reducing transaction costs, but actually they are not. If that were the case, some services of banks could easily be replaced by other agents. And we are seeing that some of these services are actually replaced right in this very moment by new players in the market, by fintech companies who can do the very same at even lower transaction costs. But still, we do need banks. And the reason for this is that they are able to offer at least a second best solution under asymmetric information. And this is important because a couple of years ago, we would have this question and this whole discussion would not have been so interesting because, well, we know we have banks, they have always existed and they will always exist. But now with the rise of fintechs, we can see that not all the services offered by banks are so crucial and so essential for the very existence of banks, but we can see that some fintechs are able to replace banks quite easily, simply by digitalization, but some other services cannot be replaced and cannot be offered by fintechs. And I would assume that most fintechs are not willing, for example, to take on deposits and to grant loans, at least not in such a way banks are doing this, because they do need, for example, in elaborate risk management, they need branches. They cannot do all the things over the internet, but there are some things that are quite essential to banking. A financial intermediary is always an institution that offers information, for example, to other investors. And it could be a bank, it could be a rating agency, it could also be a broker. But in most examples, we'll simply assume that the financial intermediary is a bank. A bank offers all services as a risk monitor, as a rating agency, also for credit and loan applications, for trading money and financial instruments, for auctioning stocks and producing financial contracts. They offer risky loan, long-term risky loans. They also offer short-term risk-free deposits. And what we do now is we try to model the market in which the financial contracts are traded, in which they are offered, and we try to explain the existence of a financial intermediary by showing that by adding a financial intermediary in these models, they can produce a benefit to all investors. And in sum, they produce a value for the economy. As I said, in a perfect market, financial intermediation is not necessary, simply because if I'm an economic agent, if I need financing, I will have all the necessary information about all potential investors. I have no transaction costs, and I can simply ask 10, 20, or 30 people of you to give me a loan and to grant me a certain sum of money, loan me a certain sum of money. Now, in a perfect market, this is not necessary. And direct financial contracts would be simpler, and because we have no transaction costs, it would cost the same. The bank has a risk transformation function by building diversified portfolios, and a risk-averse investor would be better off in this market without transaction costs, because he could also invest himself. He could also try to build the diversified portfolio by itself. So also the bank would not be necessary for risk transformation. These are all results that are closely related to the basic Modigliani-Miller theorem. Who does not know the Modigliani-Miller theorem of capital structure? One, okay. Who can state the Modigliani-Miller theorem in short? Yes?
Basically says that there is no difference in financing any investment by oneself or by a bank. So in the end, the outcome for you on the financial side is the same.
Yeah. Can you put it more simply?
Either now I save money and invest it into a firm, or I borrow the money from the bank now, invest it into the firm, and repay the bank in the next period.
Half right. The Modigliani-Miller theorem states that in a perfect capital market, capital structure is irrelevant for the firm value, for the value of the firm. So this means that in a perfect capital market, it is irrelevant if you are financing your company by 50% equity, 70%, 10%, or any other relation and any other mixture of equity and debt. The capital structure is irrelevant for the value of the firm. And this is quite interesting because obviously firms do care about their capital structure. But in the most basic theoretical model, under the assumption of a perfect capital market, capital structure is irrelevant. And you could translate this result also to risk management. The same result. In a perfect capital market, risk management is irrelevant. Because, and now this is, I think what you try to say, is that in this setting, you can either invest into a company, you can build your own company, or you can buy stocks and bonds and debt from a bank, for example, and you can create your own mixture of equity and debt. And as long as you more or less are investing into the same company of the same risk profile, it doesn't matter. With no transaction costs, and in the setting of a perfect capital market, capital structure and the mixture of equity and debt is irrelevant to your value of the portfolio. And here we have more or less the same result. In case we have a perfect capital market, it's totally irrelevant whether we have a bank or not. Actually, the bank is only creating costs for us, but we could do the very same and could achieve the very same result by simply picking the stocks and the investments we want to invest. And then we can create our own diversified portfolio by ourselves. And we do not need a bank for this. So this is not a way to explain the existence of a bank. In practice, of course, and in reality, we do not have a capital market that is perfect, and the Modigliani-Miller theorem does not hold. We have companies with optimal capital structures, and they have target debt structures and capital structures. We have transaction costs, and we have asymmetric information. So as soon as we give up this assumption of a perfect capital market, we have some points where we could argue that banks are creating value for all the investors. However, question is, how can we now explain the existence of a bank without making the model too complex? One idea would be to say that banks are able to monitor loans and monitor lenders more efficiently than you as a single investor would. This makes sense because obviously a bank has a sophisticated risk management. They have a sophisticated lending department and branches, and they know their customers, and they have sophisticated standardized processes. You as a single investor are not able to do this same monitoring in such an efficient way as the bank can do this. And it could also save on transaction costs at other points. It might also be that the bank has an advantage when it comes to reputation, when it comes to credit scoring. It's all true, But the problem is that if you do, and if you create such a model, you would simply arrive at a bank that doesn't do much more than just simply lending and deposit taking, not even deposit taking. What is the advantage of a bank when it comes to deposit taking? Well, we can all agree on credit lending. Of course, we have a sophisticated large risk management, we have branches, we have credit officers, and it makes more sense for a bank to do this if instead of us selecting lenders. But why, for example, could you not start your own deposit-taking business? What is the advantage of a bank when it comes to deposit-taking? You need a reputation, okay. But that's it, lending and deposit-taking. You are not able to explain the existence of a bank, especially when it comes to additional banking services, when it comes to investment banking, simply by looking at more efficient way of doing business and saving on transaction costs. So there has to be something different about banks. Two other explanations, a neoclassical one and one from information economics. The neoclassical approach is that, again, we have transaction costs, and this makes it inefficient in general for a single investor to offer the banking services. The financial intermediary can just lower the costs for all transactions without having to give up diversification. It can sum up and summarize all transactions, and it will still have diversification in its portfolio, but it can save on transaction costs. A very basic and very simple explanation. However, the problems always arise when asymmetric information comes into play. So then the second approach to explain the existence of banks comes from information economics, and it starts by the asymmetric information between the bank and the lender. Now, the existence of the intermediary is good and is helpful if the intermediary is able to reduce the amount and the magnitude of the asymmetric information. Now, what is the purpose then of the intermediary? The intermediary has to evaluate possible investment projects. And we will later on see in the model that this is actually what happens. We have companies or households, usually companies. Companies want to perform a project. They want to start a project. They need financing for the project, for example, by opening a branch, buying a machine. And they need to be offered a contract, a financial contract that is compatible with all the incentives of all parties involved, which simply means that it has to offer incentives to all parties to stick to the agreements of the contract and not to change their behavior. And this is what later on happens. The financial intermediary offers this kind of incentive-compatible contracts, and this is something only the financial intermediary can offer. Now, in this model, and this is one of the most famous models, it dates back to the 80s. It comes from Douglas Dimond, who is a professor of finance at the University of Chicago, one of the most famous financial economists working on banking. And we have companies and investors. The companies, and this set of slides, they are called U for the German Unternehmer, and we have investors with the German K for Kapitalgeber, which is the German word for investors. And the companies want to start a project, and the investors want to finance this project, and they want to invest in the companies. Problem is, we have asymmetric information between, of course, the investors and the companies. Why? because the company knows more about the project than the investor. If I, for example, as a company would tell you as investors, I want to start a new business in the internet. On the internet, I want to open a website offering free lectures, something like this. Of course, I know more about my ambition, about my project than you as an investor. What would happen now? You would start asking me questions. You would ask me, what is your business plan? What is your project idea? What other companies have agreed to finance your project? And you would immediately start to try to reduce the asymmetric information between us on this project. So this is the setting from which we start. We have investors and we have companies. The companies know more about the potential projects than the investors do. We could do the same as I've just laid out to you. We could say the investors start asking questions. This is extremely costly. Why should the investors start to ask questions? Why should they themselves, each and every one investor, why should each and every one investor start to reduce the asymmetric information on its own? It would, of course, be more convenient if there were a party involved that would simply gather the information on potential projects and provide all investors with the information. Well, this is the set of potential projects, and you could invest your money in this project A or in project B. And if the company and the third party involved would evaluate the projects. This is where the financial intermediary first starts to pop up. The financial intermediary in this setting, in this model, is simply a third party that gathers information and evaluates projects. And it tells investors, this project A is very good. It offers a return of, say, 10%, and we have a different project, B, that offers a return of, say, 3%. So the existence of the financial intermediary is beneficiary for all parties involved. First, the financial intermediary can lower the costs of providing the information, this additional information, because the financial intermediary is able to sell the information more than once. Second, the investor saves on money because he can buy the cheaper information from the financial intermediary instead of having to pay the cost him or herself. And finally, the company also profits from this situation because the company can generate the capital needed for financing the project. Okay. So this could work. Problem is, this approach and this model is actually very naive. It is still not able to explain the existence of a general financial intermediary in all settings. There are some situations in which we would still not go to a financial intermediary, but where we would go to simply a rating agency or some governmental agency providing the information. If this were the case, someone would simply draw up a website like Check24, Check24, or some other portal where you can compare offers and where you compare projects, and we would simply have an intermediary that gathers information. But banks do more. Banks offer contracts. Bank offer loans. Bank offer deposit contracts. So we need a little bit more to explain the existence, for example, of a bank. But you have a question.
No, it's just about a
Okay.
platform which basically offers the same like systems.
Yeah. And there are some fintechs also who do the same. For example, Smava in the US, Prosper.com. They do the very same. They offer a website on which they gather project ideas, where people can insert their project ideas, and other people can invest small amounts of money. But banks still exist. Prosper.com and Smava haven't been able to make banks totally redundant. So banks offer more than just a place where information is exchanged. So this is very naive, and we need to do a little bit better. Yes?
What's a fintech?
A fintech. A fintech is it's the slang name, I guess, for companies that have popped up over the last couple of years who try to offer banking and financial services on the internet and on smartphones and via digitalization. Smarver, prosper.com. If you take your smartphone and have a banking app like Sparkasse or Deutsche Bank, this is something that has also been offered, and this is also offered by fintechs. We also now have insurtechs. Those are small startup companies offering insurance contracts or services related to insurance. One example is Friendsurance. Friendsurance is a corporate, is I think the largest German insurtech now. Friendsurance is a smartphone app. A smartphone app on which you can buy insurance contracts, and you can enter some of your friends as co-signers, and these co-signers are willing to pay a certain fraction of your loss if you incur a loss in your insurance. For example, you could take a bicycle theft insurance contract. You look for 5 friends, and if your bike is stolen, the insurance, for example, say the bike is worth 3,000 euros. You have a theft insurance, an insurance against theft, and you have 5 friends who are willing to pay you each 50 euros. You have a bike theft insurance. The bike is stolen. 5 friends are each paying 50 euros. So you get 250 euros from your friends, and the rest of the money is the rest of the indemnity sum is paid out by the insurance company. But the insurance company can offer a lower premium because you have what in German we call Eigenbehalt. And in this situation, you, your friends, and actually Friendsurance all share the decrease in the premium and the lower premium, the discount. So this is one example of an insurtech, and this is all available on an app and through the internet, and it's offered by a startup company. Yes?
But they don't have to be my friends. I can just select.
No, actually, I think I'm not so sure how it works now, but a couple of years ago, it only worked via Facebook, actually. They totally relied on Facebook, and they have changed their business model by then a little bit. I think you can also now add friends via email or other sources. But they have to be known to you. And this is also the argument for the insurance companies, because, for example, if I own a bike and I'm able to not to surprise, but to get 5 of my friends to enter such a contract, these 5 people will know me. And the risk of me defrauding the insurance company by saying, ooh, someone has stolen my bike, this probability is much lower if people enter the contract you know, in contrast to totally anonymous persons entering the contract. So these have to be friends of yours. Of course, otherwise it would be adverse selection all over again. If you just simply select 5 anonymous people, this would be an invitation to you to defraud the insurance company. Okay. So this is, up to this point, this is very naive. Financial intermediaries do more than just gather information, and the financial intermediary would be better off if he would do the following. He would simply stop gathering information, and he would simply, or the financial intermediary would simply sell fake information to the potential investors. The financial intermediary would simply say, oh, we have this information on the potential project. The information doesn't need to be correct, but the financial intermediary can save on the costs of gathering the information, and you can still earn the money from potential investors. So this doesn't work. And on the next bullet point, you can see simply due to this fact that the financial intermediary has an incentive to save on the costs of collecting information, the investor, in this case the Kapitalgeber K, the investor K, cannot trust the information coming from the financial intermediary as well. Quite interestingly, when it comes to rating agencies, we have a situation which is close to this one. We have rating agencies which are being paid by the companies they have to rate. And in this situation, we know, post-financial crisis, we know that, of course, the rating agencies' information cannot be trusted 100%. And, of course, it is possible to incentivize the rating agencies by incurring reputation costs and reputation risk. But unless reputation risk is so high, rating agencies, of course, have an incentive to produce less accurate information than they would have. And this very naive approach is not able to explain the existence of banks. So let's stick to the most fundamental theory in banking, the Dimond model. Starting point is the company U. It's the company. The project can only be observed and can only be accurately valued by the company itself. Only the company knows what the project is worth. Not anyone outside the company, not the bank, not the financial intermediary, not the investor. And we will not try to achieve a situation in which everyone knows the exact value of the project. We want to arrive at a situation in which the financial intermediary is offering financial contracts which make everyone behave in the best way possible. And this is what is meant by incentive-compatible contracts. We want to have contracts, financial contracts in the market that force everyone to stick to the original contract and to offer all the necessary information, indirectly more or less. K, the investor, has to monitor the project, or he has to offer incentive-compatible contract, for example, by forcing additional costs on the company if the company defaults. We will later on see what this sort of non-monetary penalty could be. For example, it could be that managers and owners of a company who default will never get further employment. And this is, of course, what happens in real life. If you are the CEO of a company that defaults publicly and dramatically, you can be quite sure that this CEO will never get a post as a CEO at another company. He will be branded for the rest of his life. And the company needs to have an incentive to disclose all necessary information. The company needs to tell each other and to tell each other actor and each other player in the market what the actual costs and benefits of the project are. The financial intermediary is responsible for monitoring the companies, and it sells information to investors. And by doing this for a large set of projects, the financial intermediary is able to save on the costs of monitoring. At the same time, we have a new problem. As I've said before, we have an asymmetric information between the investor and the financial intermediary. So by solving the asymmetric information between the company and the investor, by introducing the financial intermediary, we suddenly have asymmetric information between the financial intermediary and the investor, because the investor does not necessarily have to trust the information provided by the financial intermediary. So what to do? The contract costs, or the costs of delegating this information gathering, they become low in case the financial intermediary is financing many projects, and if it is able to get a diversified portfolio. So the financial intermediary needs to lower the default risk it faces if the projects default. The financial intermediary can now save on these costs, and this is a fundamental explanation for the existence of the financial intermediary. But still, the investor cannot monitor the development of the project, of its investment. It needs to rely on the information of the financial intermediary, and we have a cooperating problem and a setting in which the financial intermediary and the investor have to cooperate in order to get the project financed. What is the basic model of Dimond? We assume we have n risk-neutral companies. Each company can start one project. We assume that all the projects have identical expected incomes and expected cash flows. And we need one unit of cash to finance one project. The company does not have any cash or liquid assets, so it cannot finance the project itself, but it needs financing from outside. To finance these projects, we have cash and we have capital from an unrestricted and unlimited number of risk-neutral investors. One investor can always invest in a project, or it can invest in an alternative. The alternative is risk-free. It's denoted by I, and I minus 1 is the market return. So we have 1 unit of currency, and if we invest 1 unit of currency, we are getting I. So 1 becomes I. For example, 1.2. And in this case, for example, I minus 1 equals 20%. So this is the return on this alternative. The investor will, of course, only invest in a project if the project offers a return that is higher than the market return. Otherwise, it will simply invest in the alternative. So we have a competition between the alternative, the market alternative, and also between the different projects. We have an unlimited number of investors, and if we have an unlimited number of investors, of course, we cannot expect the investors to earn an excess return. They will, in expectation, exactly earn I, which is simply saying that when we have such a setting, unlimited number of investors, and an alternative that offers a safe and risk-free return of I, we could simply assume that in expectation, the return is exactly equal to I. And we have no excess returns here. The company now needs m different investors. Each investor gives 1 over m units of currency, and in t equals 0, we have an inflow of cash, and in t equals 1, in this second period, we have a return of y. This is the return of the project. If our expected return on the project is larger than I, the companies could repay the investors z of y. So this means this is the repayment, and it depends on the return on the expected return, on the actual return on the project. What does it mean? It simply means that if we have a return of, say, 0.5, we can only repay 0.5. But if the return is 2 and our loan was 1, we can repay our loan in full. And the company is still able to keep the residual after repaying the loan. This is this case here, where the expected return is over I, and we can repay Z of Y. In case we have symmetric information, we can keep the expectation of Y minus I, because in this case, of course, if we have symmetric information, the repayment is exactly I. Now, as we have assumed all investors to be risk neutral, it's of no concern to us how we distribute the earnings and how we distribute the return of the projects. Next, on this slide you can see how the cash flows go from the companies, from the investors to the companies. First, we have on the left-hand side, we have the company, where the Unternehmer, and the investors on the right-hand side, and we have M investors. They are financing the projects of the companies. It's an investment of I. We have a return of Y, and we have a repayment Z that, of course, depends on how much the project has earned before that can be repaid. And the repayment is 1 over M, best case scenario. Let's do a numerical example. We have a project that requires an investment of 1 unit of currency. It offers a return of Y, the tilt, which simply means that we have 2 potential outcomes, Y1 and Y2. One best case and one worst case scenario. K, the investor, owns 0.1 units of currency, so we need 10 investors. The market return is set to be 10%. K will invest, the investor will invest if and only if the expected repayment is 0.11. So exactly the rate of return, I times the amount of money invested in the project. And the expected return of the project then is 1.22. How can I get to the 1.22? With 60% probability, we have 1.5, and with 40% probability, we have a worst case scenario of 0.8. And here, if we take this expectation, we get a value of 1.22. And as the expected return is larger than 1.1, the return on the market, it's a project that the investors are interested in. So the expected return on the project is higher, even with these 2 probabilities, even with the scenario in which, in one case, we lose money and we are not getting our loan repaid in full. Even in this case scenario, with 2 probable outcomes, the expected return on the project is larger than the return from the market. So it's a project the investors will be interested in. In case we have symmetric information, every contract in which offers a repayment per each investor of 0.11 units of currency, each contract would be of interest to the investors. So we have a repayment in case the project is a success. We have 0.13 units of currency. And in case the project and the company default, we have 0.08 units of currency. But still, each contract is attractive and of interest to the investors. The expected repayment is for all case and all investors is 0.6 times 1.3 plus 0.4. Those are the two probabilities times 0.8, and it's still 1.1, so exactly the return on the market. And the company will earn an excess profit of 0.12. This is just 1.22 minus 1.1. This is the return on the market in the alternative, and this is the project excess. What happens if we include a direct financial relation and direct financial agreement between the parties? Now again, we start with the cooperating problem between the financial intermediary and the investors. We have to show that by introducing a financial intermediary in the relation between the investor and the company, we can save on costs. May that be delegating costs, risk monitoring costs, or whatever. And of course, we have to compare this situation with a direct financial contract between the company and the investor. So we have to compare two settings. The first one is no bank at all. The second one is we introduce a bank. The company has a problem to choose useful and attractive type of contract that the investors are willing to enter. The company has to offer a contract that limits its own profits and its own ways to do business, but it is willing to do so because it can enable investors to enter the contract. Actually, we have a similar solution when it comes to adverse selection and insurance contracts. Do you have any idea how you can introduce an incentive-compatible contract to solve the adverse selection problem in health insurance? Because it's not a perfect situation for the customers either. Go back to the example smoker, non-smoker. What is the first best solution? You as a non-smoker pay 100, you pay 200. The insurance company can offer a contract for 150. You as a non-smoker are not willing to pay 150. You pay 150, you are happy because usually you would have to pay 200. The insurance company will attract all the smokers. I will go bankrupt and there will be no insurance at all. You want insurance, you want insurance. I, the only insurance company, I'm going bankrupt. And the result is market failure. And every one of us is unhappy. So what could we do? And what could we agree, all of us, what could we agree on that everyone is willing to enter the contract? A very simple solution. I could simply tell you this, and I could tell you, you have to tell me whether you are a smoker or a non-smoker, and I have to offer two contracts, one smoking and one non-smoking contract. And you have an incentive to tell me whether you are a smoker or not a smoker, because otherwise you will not get health insurance. So this is a setting where you do have to tell me something. The insurance company has additional costs because it has to gather this information and process this information. It has to offer two contracts, but this might be a solution in which helps the market failure problem in adverse selection. And we're looking for the same solution here. We need to come up with a financial contract in which here the company is willing to offer information to attract investors, because otherwise investors will not finance these projects and will need a financial intermediary to do this. So, first of all, the company has to have the incentive to tell the true outcome of the project, otherwise the investors will not enter the contract. And second, the investor will need to be allowed to monitor the success of the project. The investor needs to know what happens in the project. First idea to do this and to get and to arrive at such a solution is to enter some way of penalizing the contract partners in a non-monetary way. So, for example, non-monetary penalties include jail sentences, bad reputation, loss of employment, no future employments, all part as bankruptcy proceedings. So these are some types of non-monetary policy penalties. They have to be reasonable, especially when it comes to the investor K, and they have to be aligned with the sum of capital that is being invested by the investors. For example, if I'm an investor in a company and if I'm defrauded, if the project defaults, of course, I would not expect to be reimbursed with tenth amounts of the capital, and I would expect jail sentences also to be reasonable. So this needs to happen. Also, the investors should not get any utility from this ex post after the contract has expired. But they should give the company the incentive to stick to the contract and to provide the information and to tell the investors truthfully what the project is really worth. Okay. Now, we want to look at an optimal financial contract with such a penalty function. The amount and the severity of the penalty can only depend on the repayment of the loan. Let's stick to a loan as a project. And the company repays Z depending on Y. And the penalty has to depend on the repayment. For example, if I repay the loan in full, of course, there should be no penalty. In case I repay 50%, the penalty should be lower than if I default completely. And this is the only thing the company and the investor can actually observe. The investor knows what he or she repays, and the company knows what he or she repays, and the investor knows what he or she gets from the company. So Z of Y is the only variable that is directly observable by all investors and companies. All can agree on the repayment. No one has an incentive to lie about the repayment. The penalty function then is phi of Z of Y. And it's the severity or the amount of a non-monetary penalty that is incurred by the company if the company does not repay the loan in full. The smallest sum that is being repaid, and the smallest sum that is repaid by the company to the investor is, of course, the amount borrowed and the amount invested. So this is the smallest sum. The company will never repay more than it has originally agreed on. Why should it? If we have a loan on, say, 1 unit of currency, and we agree on repaying exactly this amount of money, the company will not repay more than this. So how should the penalty function look like? It should have an incentive effect. It should incentivize all participants, and it should especially incentivize investors to enter the contract, and it should incentivize the companies to present the information truthfully. The information and the penalty function, the optimal penalty function, is the maximum of R minus Z of Y and 0, where R is the amount of money agreed upon in the contract. So this is the loan sum, for example. if we have a loan. This type of contract is called a normal loan contract or normal claim. What happens? This penalty function is incentive compatible, which means that the company does not have an incentive to repay less than R, because otherwise it will incur the same amount of penalty, non-monetary. So why should it not repay R? I know that if I do not repay the loan in full, I will be punished for it. And this non-monetary penalty will be at least of the same amount and of the same severity as the money I'm not repaying. It has the same utility. And also, it's an optimal contract. Of course, I could construct a contract where I would say, okay, I'm a company, you are the investor, I need a loan of 1 million euros, and you tell me, okay, I have this contract, I'm punished if I do not repay the loan, I'm getting the death penalty. This is also incentive compatible because I do not have an incentive to defraud my investors. But it's not optimal. Why? Because it puts an undue burden on one party, because the penalty is much too high. So the optimal contract is one that is incentive compatible. It forces me to repay the loan, but it's also minimal. The non-monetary penalty is minimal in that sense that I'm still willing to repay the loan, but no party has to face an undue burden. And phi star of z of y is minimal. Among all the incentive compatible penalty functions, because in this setting, each penalty with a repayment between 0 and R has a lower effect and a smaller effect than actually phi of star has. And each function that has a lower penalty for not repaying the loan is not incentive compatible. So let's do this example. I start with the death penalty. And of course, I, as a company, I stick to this contract. I'm repaying my loan. Now, we have to decrease the non-monetary penalty, 10 years of prison, 5 years of prison. And at one point, I suddenly start to think about, well, maybe I will just go to jail for a month and I will not pay back my loan. And this is the point where suddenly the contract loses its incentive compatibility. And this is the point where we need to stop. And this is the optimal contract we are looking for. It's minimal and it's incentive compatible. So how should we choose R? We haven't talked about R. We have to choose R as low as possible so that the expected profit is as high as possible. We have to choose R so that the investor K chooses the project over the alternative. Of course, if he suddenly loses interest in the projects of the companies, the contract is no longer of interest. The expected repayment is the expectation of Y of Z, and this equals I, the return on the market alternative. And the probability distribution for the project profits has to be known to all parties beforehand. So we do not know what happens, but we know the distribution of the probabilities. Now, in case Z of Y is the minimum of R and Y, we have a repayment to K, to all investors, which means that the project profits, Y, are smaller than R, and the company has to give up everything it has earned from the projects to its investors. Otherwise, the companies will only pay back R. And this now causes the following. If we take the probability of the profit and the project profit to be lower than R times the expected profits conditional on the projects being lower than R, plus the probability that we have a return that is larger than R times R, this has to equal I. What does it mean? This is the probability that the project's return is smaller than the amount we've loaned. So this means the company, for example, defaults. The project goes awry and the project goes bad, and the probability on the left-hand side here, this is simply the probability that the project has a bad outcome. What happens? We are getting Y in expectation, conditional that Y is smaller than R. And on the right-hand side, what are we getting paid back in case the project is a winner? The probability that the project goes good and goes well times R, because we are only getting back the amount of money we have initially lended. Small example, let's assume we have a company, I'm in need of 1 million euros. So what should I pay back to my investors if I have 1 million euros? If my project earns 500,000 euros, I can only pay back 500,000 times the probability that my project goes bad. And in case I have a project that earns a lot of profits, I will only repay the nominal value of the loan, which is 1 million euros. Even if the project earns 20 million, I'm only going to pay back 1 million. This is R. So this is 1 million. This is, well, something like, for example, 500,000, something smaller than R. And this is the probability that the project is a loser, and this is the case the project goes well. And this expected value, the expected value of the project returns has to equal the return on the market alternative. So the expected value of that includes partial repayment in case the project goes bad, and full repayment in case the project goes well. And R minus I is the risk premium the project has to offer, because, of course, we have two alternatives. I and Z of Y. And why should we choose I if, when in this case, this is exactly the same? In expectation it is, but here, R, the repayment, has to be larger than I, and the difference is the risk premium, because otherwise we would simply opt for the risk-free alternative. In that case, we would not invest in the project. In case the project goes bad, the company will be penalized, it will be punished, without the investor having any advantage from that. Of course, there shouldn't be an incentive for the investor to punish the company in case it defaults, and to get a utility out of that. If we assume risk neutrality, we have to look at expected values, we have to look at the expected value of the return of the project, and the expected repayment is always I. And we have to look again for the first best and the second best solution. Now, under symmetric information, it always gives you the first best solution. The first best solution under symmetric information is the expected return equals I, and this means the profit for the company is the difference between the expected return minus the market alternative. In the model, we have information asymmetry after the contract has been signed. We cannot observe the behavior and the outcome of the project. We have a second best solution. We use the penalty function phi star and a suitable R, and the profit of the company is then the expected return on the project minus the repayment to the investors R, and the costs of the asymmetric information is, of course, the difference between the company profits of the first best solution and the second best solution. So we have to look at the difference between this, and we can see that this here, the difference between the repayment and the market alternative, this difference, this risk premium, is the additional cost incurred by all agents due to asymmetric information. Again, a numerical example. We have a financial contract with a penalty function and a repayment of R over M equal to 0.13 units of currency. Each investor in expectation gets 0.11 units of currency, which is just I, the market alternative return, over M, the number of investors. The repayment of the company to each investor in case the project goes well is 1.3. In the case of a default, it's 0.8 units of currency plus a non-monetary penalty. This has to be added to the 0.8 units of currency. And how should we choose the non-monetary penalty? It should be equal to R minus Y2, and in this case, this is the difference 1.3 minus 0.8, so 0.5, half a unit of currency. This is still not very attractive for the company because the expected profit would be negative. You would see that here we would have a situation where the expected profit is minus 0.08 units of currency. And in this case, the company would not choose to do the project at all. And we can also see this by looking at the welfare effects and the effects of this contract and how they reduce economic welfare. If we look at R minus I, the risk premium is 0.2 units of currency. And the expected value of the optimal penalty function here is 0.2 units of currency. And both are larger than actually the profits of the expected profits of the company, which is the expected return on the project minus the market alternative. So both are larger than 0.12 units of currency, and the company would not find this very attractive. Okay. Now, what could the company do in addition? What could the financial intermediary do in addition? It could be beneficial for the company to allow the investors to monitor the project development. The company has to pay the investors the costs for the monitoring of the project, and we suddenly would get symmetric information. This is an additional way of coming up with the existence of the financial intermediary. We try to arrive in a setting in which we have symmetric information, and suddenly we can arrive at the first best solution. So what could we do? We could, as a company, allow investors to monitor the project, and this causes costs of C for the investors. And we now have contracts with symmetric information, and contracts without penalty function are possible. Because in this case, we know that everyone has all the information on the projects, and we do not need to include non-monetary penalties in the contracts. The costs of monitoring are M times C. This is the total cost of monitoring, because we have M investors, and every investor has to invest the costs of C to monitor its project. And we have a repayment of the expected value of Y. Now, we have to compare R minus I, which is the difference between the first and the second best solution, and M times C. So in other words, if the cost of monitoring as a sum is larger than the risk premium, the company will not incentivize investors and will not pay the costs of monitoring. So what happens? Assuming that we have monitoring costs of 0.03 units of currency, the total costs of monitoring is 0.3 units of currency. We have 10 investors, and 10 investors have each to pay 0.03 units of currency. So the total costs of monitoring are higher than the costs of the contract we have just seen, which were, in this example, 0.2 units of currency. So there will be no monitoring if the company simply pays all investors to monitor its behavior. And this is where the financial intermediary will step in. The financial intermediary will make it possible to reduce the monitoring cost. It will gather information, it will process information, and in this setting we will see that suddenly the company will profit from this, the investors will profit from it, and the companies will be able to offer a first best solution by offering a contract without a penalty function, and the financial intermediary will be paid a certain amount of money to take over the monitoring of the projects for the investors and for the companies. And in fact, this is, if you think of a real bank, this is what actually happens. You, as investors, are taking your money to a bank as deposits, and you believe in the bank making the right decisions on which loans it should spend this money, and into which loan contract it should invest its money. And the bank acts as a monitor, and it monitors the different investment projects, which are the loans it grants, and it has an incentive to do good monitoring and to provide truthful information. And this is what then amounts to the duties of the financial intermediary. The last bit of information I want to give you is the title of this very famous article. And each and every year I expect that Douglas Dimond is awarded the Nobel Prize for it, because it's one of the first works in economics and the most fundamental theories in financial economics. It's titled Banks as Delegated Monitors. Banks act as delegated monitors because you as investors are delegating the task of monitoring projects to the bank, and the bank does this in a more efficient and better way than you could as an investor. Okay. Do you have any questions? It seems you have no questions. Then thank you for your attention and see you next week.